Hello, everyone. Today on the Final Bar, I'm joined by Dale Pinkert. Dale's a great, has great market knowledge and great history, experience trading the markets. We're going to get his take on what's happening right now. Overall, the market in bounce mode. Yesterday is all about distribution. Today, everything's just fine. We have another bounce off the 50-day moving average for the S&P 500. The question, as always, is this the beginning of the next leg higher or the initial bounce before the next leg down? Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the markets. We focus on the language of technical analysis, behavioral finance, investor psychology, decision-making, trend, momentum, all those items that can help us make sense of this market. As many of my mentors told me earlier on, the best thing you can do to get a read on the S&P 500 is a chart of the S&P 500. All the other stuff is noise in some ways, right? It's ways to confirm, it's ways to speculate, to develop a narrative, but at the end of the day, focus on the message of price itself. Arguably, all of that other stuff, the macroeconomic things, the geopolitical stuff, all the fundamental data, all of that should be boiled into price if we follow Charles Dow and many others, their contributions to price theory and technical analysis. When you look at the S&P 500, it is totally reasonable, I would say, regardless of what you think, if you're long-term bullish or bearish, short-term bullish or bearish, a day like today, a reaction day bouncing higher after yesterday's distribution makes sense. The question now on everyone's mind is what's next, right? How does the rest of this week play on? We have some great guests along the way to help us figure that out. I'm excited to talk to Dale Pinkert today. I've been on his show on Forex Analytics a number of times, and it's a pleasure to welcome him to StockCharts TV today. Coming up tomorrow on Wednesday, the 21st, we have Ari Wald from Oppenheimer. On Thursday, the 22nd, Jonathan Krinsky from Baycrest Partners in New York. Coming up next week on the 27th, we have Mary Ellen McGonigal, now of Simpler Trading and the MEM Investment Edge. Does a fantastic job on her shows on StockCharts TV. And also, I will be hosting the next episode of The Pitch that's coming up next week on the 27th. I will be moderating a fantastic discussion with Greg Schnell, Jeff Hughes from JWH Investments, and Mark Newton from ML Newton Advisors. Each of them will provide 5 stock picks and justify their suggestions with charts, and then we'll debate them as a group. You'll leave that discussion with some actionable ideas to keep in mind going forward. Let's continue on with our market recap. We're going to start with a poll. One of the questions we asked you recently: what outcome feels more painful to you? And I asked you, missing out on a stock that goes up 50%, or what we might call the FOMO, or the other option, holding a stock that goes down 50%, sort of the fear of losing everything, right? The fear of going to zero. Only 14% of you said missing out on the upside is more painful. 86% of you said it's the downside potential that hurts the most. And what you have all as a group illustrated is what behaviorists call prospect theory. It's this idea that we have an uneven or an unbalanced reaction to potential gain versus potential loss. And basically what it means is we don't enjoy losing a lot more than we miss out on the upside. It hurts to lose. And the reason why I brought that question up now is on a day like today, after the week we've had, this period of distribution when markets roll over, they've had this extended run, and then you get a little bit of pain. We very quickly feel that pain very physically, very palpably, right? You feel the fear of missing out, or fear of losing everything, the fear of the market going down. We all of a sudden relive all of those painful market experiences, like the March 2020, February to March 2020, the 2000 peak, the 2007 peak, depending on how long you've been doing this. And we relive those previous times when the market topped out, and all of a sudden, you see a huge deterioration of previous uptrends. So overall, that is absolutely the case. And what it reminds me now is to focus on risk management. There are times in the market when I feel like you should be focused on opportunistically looking for opportunities to the upside. I would argue now is one of those periods when it behooves you to focus more on risk management and less on potential return, and make sure that you live to invest another day. Let's continue on with our market recap today. As I mentioned, the market in recovery mode, bouncing by whatever measure we could throw at it. The S&P closing up 1.5%, so basically regained the deterioration from yesterday and a little bit more, closing just above 4320. The Nasdaq 100 a little bit less, although the Nasdaq composite was right even with the S&P. So sort of that mega cap technology trade lagging just a bit from the overall market, but overall both up just fine. Mid caps and small caps, quite the story though, with small caps up almost 3%. One of the big themes I would argue we've been experiencing recently is the underperformance of small caps, which granted, you could justify that as it's the FANG stocks, the FanMag stocks that are doing so well, and it's the small caps, the cyclicals that are lagging. Overall, that is pretty characteristic of a market top, that you see small cap underperformance. So after getting beaten down for quite a while, a nice bounce higher from small caps. The question is always, does it have legs, right? Does it go consistently further on? The VIX, by the way, down and back below 20 after gapping higher yesterday. At other asset classes, very quickly, bond prices coming down today with 10-year yields back above 1.2%, getting below 1.2% through yesterday was quite a reversal downwards. It actually went lower earlier today as bonds rallied out of the open, but at the end of the day, finishing negatively, and the 10-year yield back up just above 1.2%, still fairly low relative to where it's been in recent history. Commodities overall doing just fine, although it wasn't in precious metals. It was things like oil and copper, natural gas. Energy stocks essentially in line with the market, underperformed just a touch, but not too bad. But gold and silver, if you're looking for upside there, higher earlier in the day, but really the course of the day finished below the zero line. Where we are continuing to see distribution, it's interesting. You saw distribution yesterday on stocks and then a big bounce higher today. You did not see that from cryptocurrencies, and it's very interesting. I think it's still early days in terms of what something like Bitcoin is. Is it a risk asset or not? Is it a sign of rampant speculation or people betting on long-term appreciation of this new asset class? A day like today shows that it's not necessarily a risk on, or certainly not in a risk on environment right now, right? People are piling back into stocks, but not necessarily into cryptos right now. And again, the challenge on the charts of Bitcoin and Ethereum, which we're going to get to in our mailbag segment, is just the broad signs of distribution, right? The long-term patterns of distribution and what that means for potential upside versus potential downside. Now let's focus on the chart of the S&P 500. As we've talked about on this show for a while, I think when you analyze price behavior, when you analyze the broad markets, it rotates from, are there different things we can do? We can do leading indicators, looking at measures of momentum, looking at divergences, things like that. And then there are lagging indicators, looking at support and resistance levels, looking for confirmation from moving averages and other sorts of methods. What I would argue is what we've seen now with the S&P are some of the divergences that are pretty classic for bull market tops, things like momentum divergences, where you see the market going higher, but on lower momentum. We certainly saw that in April and May, although we've seen a bounce in momentum as the RSI became overbought once again in early July. We've seen breadth divergences where stocks, the advanced decline lines, the cumulative advanced decline lines rolling lower. So the market making new highs in July, but lower peaks in the advanced decline lines. Pretty classic for a distribution top as the uptrend is exhausted and some of the mega caps continue higher. What we have not seen, I would argue, are any of the confirmational signals, any of the indications that show the uptrend is now over and you should have very little doubt that the uptrend is continuing. That's what we've not seen. So we're sort of in this limbo right now where you've seen the early warning signals, the early warnings have been triggered, but you've not really seen the follow through. Where you have seen is we've broken trend line support. We've talked about this trend line for a while, taking the low from the end of October, connecting that to the low in early March. That lines up beautifully with the lows in May and June, again in early July. We have now broken that trend line. We're bouncing it a bit today, of course. And again, the question now would be, do we test that trend line from below? Do we find resistance there? A lot of times when support becomes resistance at the end of a breakdown, usually that's the end of the move. That could be the signal of the further rotation lower. But what we would need to really do is break below key support levels. And I would argue we're right at one of the key ones. Yesterday, we traded down to the 50-day moving average, did not close below it. We closed back above it. We've tested that 50-day moving average probably 6 times in the last 6 months. So it's been a very consistent pullback indicator, right? When the S&P pulls back to the 50-day, that is the sign that the market reverts higher. And again, I tend to assume that that's going to play out until proven otherwise. So a breakdown of the 50-day moving average, I think you will see a lot of investors treat that as a sign of negativity, as a sign of exhaustion of the uptrend. As many of us have talked about, I think the real key is going to be that 40-50 level. That's currently around 7 to 8% probably off of the all-time highs last week. So we'd have to continue a little bit further, of course, to reach that level. I think remaining above that level makes this look like an actionable pullback, a viable pullback before a move higher into the end of the year. We start breaking 40-50. I think you need to start considering the potential for further downside, and really thinking more about not just about short-term risk management, but more about getting defensive and thinking about the potential for further downside. I mentioned cryptocurrencies. We're going to get to Ethereum here in a little bit, but I just wanted to bring up the chart of Bitcoin because it's currently trading just below 30,000. And I've been asked in media outlets recently a lot about Bitcoin. I've always thought if you take a step back, you look at the big picture and how it's evolving, it's hard to see this move as anything but distributive, which is looks like a bit of a complex head and shoulders pattern, right? A high surrounded by a series of lower highs, and specifically the peak in early January, again, the peak in mid-June, and now we're testing what's called the neckline. If we break much below 30,000, all of a sudden this starts to look like a broad distribution pattern, which can measure a lot lower. And I've seen downside objectives in the 20,000s, even a little bit below, which feels like a long way from now, and it is. But 30,000 is a long way down from 64,000. We've already halved the value of Bitcoin just in the last couple months. So I was often told, never confuse the bottom of the page with support. That's my concern for something like Bitcoin. We need to take a quick break. We'll be back with my guest, Dale Pinkert. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. I'm your host, Dave Keller, here at StockCharts.com. Thank you so much for joining us every weekday after the close for our breakdown of the market activity. Just two quick reminders before we get to my guest, Dale Pinkert. Number one, we're going to do another mailbag segment a little later in today's show, and we would love to answer one of your questions. And our next mailbag segment at the end of this week, you can get your questions to us three ways: via email, thefinalbar@stockcharts.com, on Twitter @FinalBarSCTV, on YouTube. Just put a comment below the video that you're watching on our Stock Charts channel. We'll gather all of those questions. Hope to answer your question in our next mailbag segment on Friday's show. Also, as a reminder, go to StockChartsTV.com, use your email, set up a free account, and you can start watching all of our fantastic content from the website, also from all of your mobile devices. Just search on any of the app stores for Stock Charts TV on demand. I want to welcome on today's guest, Dale Pinkert. Dale's a trading coach at Eagle's Nest, does a fantastic job hosting his show, The Face discussion on Forex analytics. Dale, welcome to the show for the first time. Good to have you here.
So great to be here, Dave. I want to thank you for letting me invite myself. And also very nice to be on the other side of the microphone with you.
That's right. I was going to say, I've had so much fun going on your show. You do a fantastic job.
We can go either way on a mic, but we won't.
That's right. And
anyway,
on TradeGate Hub, I wish you well, of course, with both
thank
those.
You very much.
We have a few minutes to talk about market dynamics.
Okay.
And as I was mentioning before the break, we have this today with small caps, which has been an area of concern for a lot of investors. Talk us through this chart. What are you seeing?
Okay, well, the chart's going to look a lot different because I had to publish it yesterday. We had a huge up day across the board. We're above that breakdown level. So as you can see in that triangle, we had a lot of false breakouts that were aborted to the upside. In fact, I don't believe that the market is going to accommodate people. Normally, a good breakout is a breaks out and goes, maybe one retest, but be skeptical when the market's giving you a week or two or a month to buy it at an important breakout level. Ask yourself, why is Mr. Market letting me in and
Mhm.
making it convenient for me to make this decision a month after the fact? And then we had yesterday with a lot of risk off happening with some fears about the Delta virus. And today, we closed back above the triangle breakout. So, there's an expression, Dave, that markets bottom in silence and top with violence. And you're starting to see a little bit more of that violent action in the VIX. It looked like we had a breakout 2 weeks ago when we went to about 22 and then sold off to 16. Then we made new highs in the VIX yesterday, looked like a breakout over 21. And today we closed back under it. But one thing I have to say is that the VIX to me looks like it's under accumulation. There are a lot
Mhm.
of very important, I call hammers or ghost pips where they would open the VIX sharply lower. I don't think anyone got a trade off there, and it would come back and form a candle on a hammer. So I'm leaning towards the bear side of your analysis right here. And even though the Russell came back, unless rotation is going to be so vicious that people start moving out of big tech and growth and cyclicals into the Russell, I doubt there's going to be a new high. I still think that what we're getting here is a failing rally in the Russell. I'd be surprised to see it trade back over 228. In fact, both the S&P and the Nasdaq on today's bounce retraced 61.8. And I actually think that there's a chance during this correction for the Russell to trade back down towards the gap and the pre-COVID high of
Mhm.
170 and possibly 140. So I'm a pretty big bear here. I'm making a big call that we're going to enter a corrective period. I think it's backed up by crude. I think the picture has changed. I don't rule out another new high in Nasdaq or S&Ps, but the break in crude, I think, broke the back of that commodity market.
Mhm.
Copper rebounded today, but it's under pressure. So we're in for a pause on the inflation trade. And if yields are going to bottom, it shouldn't be so good for growth. So we could go to the NASDAQ 100. From one
So,
extreme to the other, Dave, is this has been the strength, Russell being the relative weakness, followed by the Dow. The Dow didn't take out its March high till last week. So we had a rising wedge. We have a rising wedge here. And the action above the wedge is what I call a throwover,
mm,
and that usually happens. It's usually some type of terminal thrust where the market's accelerating above prior resistance. And the NASDAQ did have some confirmed highs on the daily. All other time frames, including weeklies, are diverging badly. The way to trade it is, if you're not like me and you want to hear the ice crack, you wait for the confirmation to close back inside the upper wedge line, the throw over to be negated. And that's going to come in around 14.3, 14.280. Once we're back inside of that formation, that activates the wedge again. And I'm a
mm,
believer in wedges can retrace 100% of the move, and I have it anchored there around the 10,000 level. It's had three hits on that wedge line right there, and I think that that's a possibility that's going to be a rocky summer, especially if we don't get anything done in infrastructure, because
mm.
there's nothing like a 30% correction in stocks to get constituents of the Republicans to call their senators and congressmen and say, my 401k is taking a hit. Let's
Mm,
get some fiscal stimulus going here. I saw it happen with TARP, and it might even be engineered. And actually, I don't think Yellen's it didn't really give a full-throated endorsement of Powell, and Powell could be the sacrificial lamb. Maybe Powell will do the right thing, and knowing that his tenure is maybe coming to an end with Brainerd replacing him, and I think the market's vulnerable. I think people should buy insurance. You buy insurance on your home, fire insurance, not because you hope there's going to be a fire, Okay, just in case there is a fire. And this is definitely a stretched out equity class. And I'm looking at a lot of different FANG stocks that even if they make marginal new highs, they will not confirm. I like at the minimum raising cash in the Nasdaq 100, David.
It's certainly a cautious tone, Dale, and I think well justified. I think when you talk about the Russell 2000 and the potential sort of failed breakout, we've seen on a lot of charts as well. I think those are points well taken. Dale Pinkert, listen, thank you so much for joining. I wish we could spend hours talking because you're a wealth of knowledge. We'll have to do it again sometime. All right.
Well, I drink from the cup of wisdom with my new StockCharts.com coffee cup. Thank you, David.
Cheers,
Good
Dale.
hunting,
Be
my
well.
buddy.
Stay safe. Talk to you soon.
Bye-bye.
That's Dale Pinkert. Dale is the trading coach at Eagle's Nest. Does a fantastic job on his shows on Forex Analytics and TradeGate Hub. I encourage you to check out his work. He's just a fountain of market wisdom, and it's a pleasure. It's been a pleasure getting to know him and his work. You know, it's interesting when you talk about when he talks about those failed breakouts. You know, it reminds me a lot of the chart of Apple that we've looked at and Amazon and others. Right, these are charts that, given a normal plain vanilla environment, you'd expect those breakouts to continue. We're not seeing that. We're seeing, we're seeing those things fail at after breaking out. I think the Russell 2000 may be another example of that sort of cautionary tale of failed breakouts. We need to continue on. Go to the Final Bar mailbag, answering your questions. As always, shoot us an email with any questions that are coming up in your own process. Our email is thefinalbar@stockcharts.com. Let's get right to it. Question number one, I need your help to find out what is the best way to identify the stocks that are good candidates to short in the market downtrend. Any recommendations? That's a really good question. And while I can't tell you specifically what to do, I will tell you some of the things that I've done for a while. My process involves a lot of individual scanning of a lot of charts, looking at the S&P 500 charts from top to bottom. It's also looking at scans, and I run a couple scans a couple times a week, really. These two are called new swing highs and new swing lows. Those charts those screens are driven particularly on 3 months highs and 3 months lows. It's interesting in an environment like this where the market's turning so quickly, you might want to actually dial down the time frame a little bit. Instead of looking at 3 months, maybe do a new 1 month low. And while I would not say short these stocks simply because they appear on the screen, what it shows you is that these are the charts that are showing the characteristics of price weakness. These are things that are undercutting, in this example, their lows from the last 3 months. And I think that's cause for concern. And again, I've not looked at the screen yet today, but one of the charts that comes up is Newmont Mining. Now, on a day like today, of course, most things bouncing higher, so very few on the screen. If you run the screen as of yesterday, which I'd encourage you to do, it shows you things that are not just pulling back and things that are really breaking down through support. Today, though, for example, you have Newmont Mining, which is instead of bouncing higher like most stocks did, this stock actually managed to trade lower, right? It's actually down today while most things are back up, and that is a cause for concern. Breaking down through a neckline, if you take this as the head, the left shoulder, the right shoulder, the neckline, you can connect those intermediate lows, lines up with the 200-day moving average. It's now breaking below it. In my experience, those are the types of charts that I would be leaning away from, and that's usually the language I use, because it depends a lot on you and your particular situation, how you're trying to approach things, how aggressive you're trying to be, what your strategy is, what your time frame is, and it's hard for me to make a blanket statement that would make sense for everyone. So I just try to talk about the language of leaning away from things or leaning into things. And this is the type of chart, a chart making new swing lows, a chart that's underperforming, making new relative lows. Those are the charts that I would tend to avoid. And I would caution you, in an environment of distribution, a lot of things are going to be coming oversold very quickly, especially if this thing continues another downward. So I would avoid getting all excited when something becomes oversold and expecting a quick bounce. It might not come, actually. You can see things that are oversold for quite a while. Next question, does this look like a head and shoulders? Not looking good, but 'tis a crypto, so only time will tell. It's a very poetic way of asking your question. This is you sent a different chart, but I'm using my version of it, if that's okay. And you're saying basically, is this a head and shoulders top? And the answer is, kind of. I found with with price patterns, there's sort of the plain vanilla example that you would read in the John Murphy book or the Martin Pring book or the Edwards and McGee book on chart patterns. But then you have what actually occurs in real life, which is not always as beautiful and as scripted as the classic topping pattern. So is this a head and shoulders pattern? I would probably call this either a complex head and shoulders pattern or a head and shoulders like pattern, but it's close enough for me. And what I see is the head in May, and then you see a series of lower highs, and I'm seeing highs in June and in July. I'm also seeing lows and subsequent highs here in February and in March. And I think if you connect the neckline, which are the intermediate lows, we've just broken that this week. Probably yesterday is when I would consider it broken. And the bad news for Ethereum and for a lot of cryptocurrencies, that measures a lot lower, down back into the 600 range back in December. Again, I'm not doing this super scientifically. I'm just kind of visually analyzing it. But basically, all the cryptocurrencies, they break these levels not too far below where they're at. They measure a lot lower if you consider this a broad head and shoulders top. And I would probably call it a complex head and shoulders, which is where we have a head and multiple shoulders. That's kind of what you do, but a very stable neckline, which I would argue this is. Next question, how do you interpret the following chart? And this is the one that you sent to me. The broad market has been down a lot, but why do the high-low lines of NDX and SPX still go up? Are the settings of my chart incorrect? Right. No, the setting is not incorrect. I would say what you're charting is a little bit deceiving. And here's what I mean. These indexes, $SPX, HLP, and others are actually the high-low percentage. So what that does is every day, it shows you stocks making new 52-week highs, stock making new 52-week lows. And if I remember right, it's a percentage of the highs minus the lows. And then you're plotting them as a cumulative line. So it's actually accumulating those values, which makes sense in general. If the market's in an uptrend, this line should be going up. If the market goes down and you have a lot more distribution, the line should be going lower. So you're not really seeing that. But if you go back to like February, March of 2020, you'll see the lines go very, very negative. The reason why they're not going anywhere but up right now is because very few stocks are making new 52-week lows, because the 52-week low is so far away, right? If you think about what's happened in the last 12 months, the July 2020 low for most stocks is way below where we're at right now. So it would take such a deterioration to trigger that. These lines will most likely continue to go higher. But so I think this is a fair measure of breadth, and I don't think you're charting it incorrectly. I would say, though, this is the kind of thing when you've had a market in an extended bull run, this is the type of breadth indicator that would not react as quickly just because we're so far from the 52-week lows for the average chart. I would encourage you to look at things like advanced decline lines, which are a little more reactive. Stocks above their moving averages, those are going to react a little more quickly because they recognize when distribution happens more quickly off of all-time highs. Hope that helps. Last thing, and then boy, we got a wrap here. Any heuristics for swing high and low determinations? Sometimes they can be quite tricky. Yeah, so I've been asked about this a number of times. Now, do you have a way of systematizing whether something's making new highs and new lows, or lower highs and lower lows? The phrases that I say over and over and over. And I would say, to be honest with you, I don't. I tend to think of that much more subjectively, because for me, it's looking at the chart and seeing, are the highs getting higher and the lows getting higher or not. There are some different ways you can do it. We actually have an overlay indicator called Zigzag, which I would point you to, which actually helps quantify it. There are a couple different versions of it. And if you want to check it out, go to the Chart School articles on the Zigzag indicator. You can see what it does, but it basically uses percent swings to try to do it. What I found is that's helpful as you're just learning the methodology. Eventually, it's just like Elliott Wave. I'd much rather have a blank chart and apply my own analysis of those types of patterns. I hope that helps. We need to wrap the show. Go to the 3 in 3 charts in 3 minutes. Here we go. Chart number 1, I was asked to talk about on social media, just my main levels for the S&P 500. For me, we have pulled back. I agree with my guest, Dale Pinkert. I don't think we're at the end of the correction by any means. I think days like yesterday are an indication that there's much more pain to be had in terms of price and time. I would say breaking down through the 50-day moving average would be a key line in the sand following that 40-50. I think we could end up remaining above that, but that's a key level I would look at. The 50-day is going to be key for the rest of this week. Chart number 2 is Bitcoin. I just can't help but pointing out continued lower highs in momentum. We've seen that again here in July. We're testing 30,000, which I think is an ultimate line in the sand. I think we've gone on to the low 20s, if not further. Finally, looking at offense versus defense, I did a webinar of my own earlier today for market misbehavior. You can go to my website for more information, marketmisbehavior.com. But basically, we really haven't seen a big change from offense to defense in consumer. We've seen offense over defense going through March. We've seen offense and defense in alignment. We have not quite seen a breakout, but that is an important chart to watch going forward. Folks, that is our show for today. Thank you so much for joining us every weekday after the close for our show. A special thank you to Dale Pinkert, for joining us today. From everyone here at StockCharts.com, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.